Welcome everyone. If you've been following the energy news lately, you might be feeling a bit of whiplash. On one hand, we are told that green hydrogen is the holy grail of the energy transition, with billions of dollars in new investment flowing in every quarter. On the other hand, we see headlines about major projects being mothballed or cancelled entirely from Australia to Europe. It feels like two completely different stories are being told at the same time. Today, we are going to investigate this paradox. We'll look at why investment is still rising while projects are failing, and we'll uncover the truth about the two hydrogen markets that are emerging today, one built on hype and one built on reality. By the end of this session, you'll understand the why behind the cancellations and what it takes for a project to actually survive in this competitive landscape. We are looking at a fundamental shift in the industry, and it is vital to understand the difference between a press release and a real asset. Both statements you see on the screen are true at the same time. Hydrogen is shrinking, and it is growing. This sounds like a contradiction, but it describes the two distinct phases of the market. The announcements phase, the era where companies could gain stock value just by mentioning hydrogen, is shrinking rapidly. The speculative bubble has burst. However, the investment phase, actual capital being deployed into mature, bankable projects is growing. We are seeing a flight to quality. While the total number of projects in the pipeline might be decreasing as weak players exit, the dollar amount committed to the survivors is reaching record highs. This is the hallmark of a maturing industry. We are moving away from horizontal growth, where everyone tries everything, to vertical growth, where the best ideas are scaled up. It's a dual reality that requires us to look past the surface-level headlines to see where the real value is being created in the energy transition today. Let's talk about the cancellations. We've seen them across Europe, North America, and Australia. In the past 18 months, several multi-gigawatt projects that were once the darlings of the industry have been delayed, redesigned, or cancelled altogether. Why? Because the initial assumptions were often too optimistic. Many of these projects were designed when interest rates were near zero and supply chains were stable. As the world changed, these projects couldn't handle the stress. In Australia, massive export-oriented hubs have been put on hold as the cost of shipping hydrogen became clearer. In Europe, regulatory uncertainty has slowed down the progress of once promising inland clusters. In North America, even with the incentives of the Inflation Reduction Act, projects are being redesigned to fit more realistic timelines. These cancellations aren't just failures, they are a recalibration. The industry is learning that geography, local regulation, and logistical reality matter far more than just having a big vision on a map. Despite the cancellations, investment has not stopped. This is a crucial point for any investor or policymaker to understand. Capital is not leaving the hydrogen space, it is simply becoming more selective. Banks, private equity funds, and industrial giants are still moving hundreds of millions of dollars, but they are no longer throwing money at every startup with a power-to-gas pitch. They are looking for bankability. They want to see projects that have secured their power supply, have a clear buyer for their product, are supported by stable government policy. We are seeing a concentration of capital in regions that have moved first on infrastructure and clear tax credits. The money is moving toward the sure bets, or at least the projects that have mitigated their biggest risks. This selective investment environment is actually a sign of health. It means that the projects that do reach completion will be economically sustainable for the long term, rather than relying on constant infusions of speculative cash. During the initial hydrogen boom, thousands of projects were announced globally. It was a race to the top of the leaderboard for total gigawatts announced, but the boom filled the pipeline much faster than it could ever fill the order books. The industry fell into a trap of thinking that a project in a spreadsheet was the same as a project in construction. What we are seeing now is the inevitable gap between those two things. Many of those early announcements were made by companies without the balance sheets to actually build them, or in locations where the infrastructure simply didn't exist. Now that the hype cycle has peaked, we are seeing the correction. The thousands of projects are being filtered down to the hundreds that actually make sense. The order books represent reality. Who is buying the electrolyzers? Who is pouring the concrete? Who is signing the 20-year purchase agreements? That is where the industry's real progress should be measured, not in the aggregate gigawatts of press releases. It is vital to remember, a project announcement is not a project. Every stage of development is designed to remove weak projects from the pipeline. Think of this as a funnel. At the top, you have the announced phase. Anyone can do this. Then comes feasibility, where you realize the engineering challenges. Then offtake, where you find out if anyone will actually pay for the product. Then finance, where the bankers tear your business model apart. And finally, the holy grail, FID, or final investment decision. Each of these steps acts as a filter. In a healthy market, you want the funnel to be narrow at the bottom. If every announced project reached construction, we would have a massive oversupply and a waste of capital. The reason we are seeing so many cancellations is simply that projects are failing to pass through these filters. This is exactly what should happen in a disciplined market. By the time a project hits FID, it has been stress tested and proven viable. That is the point where the real value begins. The first and most important filter is cheap electricity. We call this the first filter because the price of power determines roughly 60 to 70% of the cost of green hydrogen. If you don't have access to low-cost, reliable, renewable energy, your project is dead on arrival. But it's not just about the price per kilowatt hour, it's about utilization. If your electrolyzers only run when the sun is shining or the wind is blowing, your capital costs stay high because your output is low. The winning projects are those that can find a balance. Low-cost power combined with high run times. This is why we see a shift toward projects co-located with massive wind and solar farms, or projects that have smart grid connection agreements. Without this fundamental economic advantage, no amount of government subsidy can make a project competitive in the long run. The electricity price isn't just a variable, it is the foundation of the entire business case. The second filter is even more practical. Someone must actually buy the hydrogen. For years, the industry operated on a build it and they will come philosophy. We now know that doesn't work. The demand has to already exist, or at least be contractually guaranteed before the first shovel hits the ground. This is the offtake challenge. Green hydrogen is currently more expensive than the fossil fuel-based gray hydrogen it replaces. Therefore, you need a customer who is willing to pay a premium for that green attribute, perhaps because of carbon taxes, regulatory mandates, or their own corporate sustainability goals. The revenue path never closes without a buyer. This is why projects situated near existing industrial hubs, like steel mills or chemical plants, are moving forward while isolated projects in the desert are stalling. A project without a buyer isn't a business, it's a hobby. The strongest projects today are those that have signed binding, long-term offtake agreements with creditworthy customers. The third filter is infrastructure. Connection beats isolation every single time. You can have the cheapest power and a willing buyer, but if you can't get the hydrogen from point A to point B, you don't have a project. Hydrogen is notoriously difficult and expensive to transport. This is why storage facilities, pipelines, and port access are critical. The island projects, those not connected to a wider network, have to bear the entire cost of logistics themselves, which often ruins the economics. Conversely, projects that can plug into a growing hydrogen backbone or share a port facility with other users can spread those costs. We are seeing the rise of hydrogen hubs where multiple producers and users share the same infrastructure. This reduces the risk for everyone involved. If you are looking for where the industry will actually succeed, look at the maps of existing pipelines and major shipping ports. That is where the hydrogen economy is being built, one connection at a time. We must also talk about the macroeconomic environment. Higher capital costs have fundamentally changed the math for hydrogen development. When interest rates were low, the massive upfront cost of electrolyzers and renewable energy plants, the capex, was manageable. But as rates rose, the cost of debt increased significantly. For a capital-intensive industry like green hydrogen, a 3 or 4% increase in interest rates can make a project's output 30% more expensive. This has reshaped project economics overnight. It has forced developers to be much more disciplined about their debt-to-equity ratios and their expected returns. Projects that looked marginal at 2% interest are now underwater at 7%. This math problem is a primary driver of recent cancellations. It has served as a brutal reality check, forcing the industry to find ways to lower capex through better engineering and scale, rather than just relying on cheap money. The math doesn't lie, and right now the math is demanding higher efficiency and lower risk. There is a specific danger we've observed. Mega projects created mega risks. In the early excitement, everyone wanted to build the world's largest hydrogen plant. But larger projects accumulate more dependencies. They need more land, more power, more water, more permits, and more financing. If any one of those pieces fails, the whole multi-billion-dollar project stalls. This complexity risk is immense. We've seen that the bigger the project, the more likely it is to be delayed. The complexity isn't just linear, it's exponential. A 5-gigawatt project is not just 10 times harder than a 500-megawatt project. It might be 100 times harder to coordinate. This has led to a scale paradox, where the very projects meant to show the industry's strength became its biggest vulnerabilities. We are now seeing a pivot toward more manageable, phased developments. The lesson here is that you have to learn to walk before you can run. The mega risks of the giant hubs are being traded for the manageable risks of smaller, modular installations that can be expanded over time. Infrastructure isn't built overnight. Hydrogen networks take time. We see maps of hydrogen corridors stretching across continents, but these connect industry gradually, not instantly. There is a sequence that must be followed, starting with operating clusters, then building the connections between them, and finally creating a national or international planned network. Many projects were announced as if the network already existed. But developers are finding that building a new pipeline or retrofitting an old one involves years of permitting, environmental studies, and construction. This time lag is another reason for the cancellation headlines. Projects that were banking on a pipeline being ready by 2026 are realizing it won't be there until 2030. This timing mismatch forces a rethink. The lesson for the general audience is patience. The hydrogen transition is a multi-decade infrastructure build-out, not a quick tech upgrade. The projects moving forward today are the ones that have accounted for this infrastructure lag in their business models. To reiterate a painful truth, many of the projects that were recently canceled had no guaranteed customer. They were built on spec. In the real world of industrial finance, no buyer means no contract, and no contract means no finance. It is a domino effect. Without a take-or-pay agreement from a creditworthy entity, a bank will not lend the hundreds of millions of dollars required to buy electrolyzers. Many developers spent years on engineering only to find that the local industry wasn't ready to sign on the dotted line. This is why the revenue path is the most critical part of the slide deck. You can have the most beautiful engineering drawings in the world, but if your revenue path doesn't close, you don't have a project. We are seeing a shift where developers are now starting with the customer first and working backward to the technology. This customer-centric approach is significantly more successful than the technology-first approach of the previous few years. So why should we be optimistic? Because money is moving to better projects. What looks like a retreat from the headlines is actually a screening process. Think of the market as a series of filters. The speculative, poorly sited, and underfunded projects are being screened out. This leaves behind a concentrated pool of high-quality, funded projects. This is not a retreat. It's a focus. When capital becomes scarce or selective, it flows to where it can be most productive. We are seeing a flight to quality that is ultimately good for the industry. The funded projects of today are much more likely to become the operating plants of tomorrow. By filtering out the noise, the industry is actually speeding up its real-world impact. We are trading 1,000 maybe projects for 100 definitely projects. That is progress. It means that the resources, the engineers, the steel, and the capital are finally being used where they can actually succeed. The smartest move the industry is making right now is the decision to replace gray hydrogen first. Today, we already use millions of tons of hydrogen in ammonia production, fertilizer manufacturing, and oil refining. This hydrogen is currently gray, made from natural gas, which releases significant CO2. The infrastructure and the demand are already there. The demand is on the meter. Instead of trying to create brand new markets for hydrogen cars or residential heating, the winning projects are simply swapping out the gray hydrogen for green hydrogen in existing factories. This removes the market creation risk. If you are an ammonia producer, you already know how to use hydrogen. You just need a cleaner source. This focus on industrial feedstock provides the fastest and most reliable path to scale. It allows the green hydrogen industry to build up its volume and lower its costs in a controlled, predictable environment before moving on to more complex new applications. Shared infrastructure changes the entire economic equation. We are seeing the rise of industrial clusters. In a cluster, a single massive electrolyzer can provide hydrogen to a steel plant, a storage facility, and a port for export all at once. By sharing the cost of the electrolyzer, the storage tanks, and the pipelines, each individual user pays less. This is the cluster effect. It spreads the financial burden and creates a local ecosystem of supply and demand. If the steel plant has a slow month, the ammonia plant might take the extra supply. This flexibility reduces risk for the producers and the lenders. These clusters are forming at major ports in Rotterdam, the Gulf Coast of the US, and parts of Australia. They represent the most efficient way to build the hydrogen economy. By concentrating users together, we overcome the logistical challenges that have killed so many isolated projects. The future of hydrogen is not in individual plants, but in these integrated industrial hubs. Let's be very clear. Long-term buyers make projects financeable. This is the golden rule of energy projects. In this image, you see the three-way relationship that makes it happen: the contract, the lender, and the capital. The contract comes before the capital. A bank, the lender, needs to see that someone will be paying for the hydrogen for the next 10, 15, or 20 years. That contract is the collateral. Once you have that, the capital flows. This is how wind and solar grew to be the giants they are today, and hydrogen is following the same path. We are moving away from spot market thinking toward long-term partnership thinking. Developers who are successful today are those who act more like infrastructure partners to their customers, rather than just equipment sellers. They are signing deals that share the risks and the rewards of the transition. When you see a project reach FID, look for the long-term contract behind it. That is the engine that actually drives the investment. We cannot ignore the role of the state. Government support can close the green premium gap. Right now, green hydrogen is more expensive than gray, and policy is the bridge that spans that distance. Whether it's production tax credits in the US, hydrogen bank auctions in Europe, or direct grants in Asia, these incentives lower the risk premium for investors. Predictable policy is the key word here. Investors don't mind high risk, but they hate uncertainty. If a carbon price is high and stable, or if a subsidy is guaranteed for a decade, the math becomes predictable. This predictability allows lenders to offer lower interest rates, which in turn lowers the price of the hydrogen. Certification is also vital. Buyers need to know exactly how green their hydrogen is to meet their own regulatory requirements. The governments that provide clear long-term rules are the ones seeing the most projects move from plans to construction. A major trend we've identified is that right-sized projects can move faster. While the headlines focus on the 5-gigawatt plans, the actual progress is often happening in the 100 to 500 megawatt range. These projects are large enough to achieve economies of scale, but small enough to be financed by a single group or built within existing industrial sites. They use off-the-shelf technology that is already proven. By starting with a right-sized project, developers can get to construction faster, start generating revenue, and learn valuable lessons before they scale up to the gigawatt level. It's the difference between a massive, risky leap and a series of calculated steps. We are seeing a lot of those 5-gigawatt mega plans being broken down into smaller, phased build-outs. This is a very positive sign. It shows that the industry is prioritizing getting it built over getting it big. Success in the 100 megawatt range is the best evidence that a 1-gigawatt project will eventually work. So, what does success look like? The strongest projects are moving forward through a very specific sequence. It starts with feasibility, then moves to securing permits, which is often a major hurdle, then signing the offtake agreements, then arranging the finance, and finally reaching FID and construction. Look at the icons on the screen. These are the milestones of reality. The projects that are surviving are the ones that have respected this sequence. They didn't try to get financing before they had permits. They didn't try to reach FID without a buyer. By following this disciplined path, these projects build credibility with every step. When you hear about a project that just secured its environmental permits or signed a new offtake deal, you are hearing about a project that is winning the war of attrition. The industry is being whittled down to its most capable members, and these are the projects that will form the backbone of the future energy system. We are witnessing a historic transition. Hydrogen is moving from plans to plants. We are moving away from slideware, those beautiful PowerPoint presentations that promise the world, and toward operating assets. In ports and industrial zones around the globe, electrolysis units are being installed, storage tanks are being filled, and green ammonia is being loaded onto ships for export. These are no longer just experiments. They are the early stages of a new global commodity market. The operating assets are the ultimate proof of concept. They provide the data that the rest of the industry needs to improve. They show that the technology works at scale and that the economics can be managed. When you look at the industry, don't just look at the proposed capacity. Look at the capacity that is actually drawing power and producing molecules. That is the only metric that truly matters for the energy transition. I want to leave you with a perhaps controversial thought. Cancellation can be healthy. In any new industry, there is a period of irrational exuberance where too many bad ideas get funded. Pruning a garden is necessary for the flowers to grow, and the same is true for the hydrogen market. By canceling the projects that were poorly located, badly engineered, or economically unviable, the industry is clearing the way for the ones that can actually succeed. This means fewer projects in the headlines, but stronger, more bankable projects in the ground. We should view the current wave of cancellations not as a sign of the industry's failure, but as a sign of its maturity. The hype is being replaced by discipline. We are moving into a phase where quality matters more than quantity. A smaller, more robust pipeline of projects is much more valuable than a massive pipeline of pipe dreams. To summarize, there are 5 things that every strong project must have to survive the current stress testing. First, cheap power, the fundamental cost driver. Second, infrastructure, the ability to move the product to market. Third, offtake, a guaranteed buyer who will pay for the green premium. Fourth, policy, stable government support that reduces uncertainty. And fifth, finance, a structure that can withstand higher interest rates and complex risks. If a project is missing even one of these 5 pillars, it is likely to end up in the canceled column. But if it has all 5, it is built to last. These are the fundamentals that survive stress testing. As investors, partners, or observers, these are the 5 criteria you should use to judge every hydrogen announcement you see. The projects that check all 5 boxes are the ones that will change the world and define the next century of energy. We are moving from hydrogen hype to hydrogen discipline. The era of gigawatts announced is over, and the era of projects financed has begun. This shift is represented by the arrow on your screen. It is a move from speculation to bankability. Discipline means making hard choices. It means saying no to projects that don't have the right location or the right partners. It means being honest about the costs and the timelines. While it might feel less exciting than the wild growth of a few years ago, this discipline is what will actually deliver a decarbonized economy. The projects that emerge from this period will be the workhorses of the future. They will be built on solid ground, literally and figuratively. The transition to discipline is the most important step the hydrogen industry has ever taken, and it is the reason why green hydrogen will ultimately succeed despite the current challenges. In conclusion, hydrogen investment is rising, but only the strongest projects will survive. Capital is moving from vague announcements to bankable infrastructure. We have seen that the 3 main pillars, power, electrolysis, and industry, must be connected by the 4th pillar, finance. The cancellations we see today are simply the market doing its job, filtering out the weak so that the strong can thrive. The future of hydrogen is bright, but it is a future built on economic reality, not just environmental hope. We are building a new global industry from scratch, and that is never easy. But for the projects that have the right fundamentals, the opportunity is immense. Thank you for your time today, and I look forward to seeing this industry move from the drawing board to the real world, one bankable project at a time. The survival of the fittest is underway, and the winners are already starting to show themselves.